Welcome to today's edition of Toggle's Daily Video Insights. For all of you who are joining us for the first time, welcome. We take a look at one of the many insights that Toggle produces across 15,000 assets it monitors and deep dive into a lot more detail about what it's actually telling us about the price pressures, drivers, and so on. So if you'd like to see more of these, please by all means subscribe to our YouTube channel or check us out on toggle.global, where you can also actually test the system we're using, which is Toggle Copilot. The focus today is going to be on Sprott Gold Miners Index. What you are seeing here in the asset overview, which those of you who are using the system will be familiar with, is that there have actually been quite a number of positive price pressures that have recently emerged for this ETF, and more or less they have been playing out so far. Now, the one that we're going to take a look at today is the latest one that had just popped out based on a technical indicator, and so clicking on this will take you straight into the actual insight, which here it's highlighting that on the basis of the 10-day, 200-day price MACD. Again, for those of you fans of technical analysis, no need to explain what that is. For everybody else, it's really a divergence between two different moving averages, the 10-day and the 200-day. So the low between those indicates that perhaps the sell-off that we've seen in the ETF recently until the recent recovery may have truly and well bottomed. And so from 27.79, the median projection based on 7 similar occasions the Toggle has analyzed would place it around 34.74 within the next 6 months. Now the red line here suggests that, of course, that if you were to see the price, instead of following this pattern within the confidence interval, to actually deviate from it and actually fall below the red line, it's a major sign that the thesis needs to be reevaluated, that perhaps this driver is currently being dominated by some other driver that is bearishly impact the stock, and so this is the point to get out. Now, why might it move? Here you're able to actually see visually what historically this divergence between the two moving averages has reached. So the divergence between the 10-day and the 200-day, you don't really see these divergences quite that often. And so on the handful of occasions, 7 again, as you remember, that we have seen it, it typically led to a rally, at least to some extent, in the gold miners, and potentially sometimes it extended quite a bit further. But either way, it typically signaled that the bottom was in place and that actually in the near term there was more upside than downside in the particular ETF. Looking at the back test, we get the same result. So the way to look at this is you can see how would you have done if you had invested $1 and reinvested it each time when this insight had been generated in the past. And then also what were the actual versus the target returns. So you can see that pretty much all of the actual returns were well in the positive territory, with really just a handful down here that were in the negative territory. So quite a good convexity, quite a good risk reward to this particular trade. So it's worth taking a look and seeing whether or not owning gold miners fits with your overall fundamental view of where you think gold is headed and where this particular sector is going to go. So much for the gold miners today. In the daily brief, which if you subscribe to it should already be in your mailboxes, we also discuss a very unusual divergence that has become a more permanent fixture between NASDAQ and the Dow, and what that has meant historically for market performance going forward. If you don't have it, you can subscribe at toggle.global. Otherwise, we'll see you again tomorrow. Thank you for your attention.